Hello and welcome to Indianomics. This week we focus on the issue of priority sector lending by banks. Now, priority sector lending originated in 1968 along the time when banks were nationalized with the aim of using their funds for nation building. Banks were told to lend 1/3 of their funds to sectors that the government determined as priority, largely agri and small scale. By 1985, this proportion actually rose to 40%. Now, why is the issue now in the news? Because a committee headed by former Union Bank Chairman M.V. Nair recommended that banks may directly lend 9% to small farmers and 7% to micro industries. The remaining targets, the committee recommended, be loosely defined to include even lending to, say, warehousing or cold chain as lending to agriculture, making it basically easy. Now, the recommendations were, however, not accepted in toto by the Reserve Bank. Under the new dispensation, nothing much has changed except that it became more punishing for foreign banks. But we will come to that a little later. Here's how the current targets under priority sector look like. Overall priority sector loans 40%, lending to agriculture 18%, direct loans to agriculture 13.5%, indirect loans to agriculture 4.5%. Other sectors included in the priority sector are as follows: micro industry, that is loans up to 1 crore, housing loans up to 25 lakh in small towns, loans to food processing units, education loans under 10 lakh for domestic students, 20 lakh for foreign students or students going abroad, loans to farmers indebted to money lenders. Well, now, to analyze the current rules, I have with me three stalwarts. Mr. R.K. BAKSHI, Executive Director of Bank of Baroda, ASHWIN PAREKH, Partner at Ernst & Young, and Professor T.T. Ramohan, Professor of Banking at IIM-AHMEDABAD. Gentlemen, welcome. Well, actually, Professor, let me start with you. Do you really need the government to decide for banks 40% of where they lend? Should not the market be doing that? Do we need a priority sector at all?
Well, we need it for a number of reasons which I think have been made plain in the public debate over the past many years. One is that the priority sector includes very important components like agriculture and the small scale sector. Now, agriculture may be only about 20% of the economy, but it has a large proportion of population still living on land, more than about 55%, I think. And then the small and medium enterprises account for nearly 50% of our manufactured exports. So I think you need credit to go into these sectors, and it's next to impossible to see why banks would be directing the requisite amount of credit to these sectors unless they are told to do so, because there are all kinds of opportunities waiting for banks right under their noses in the urban areas and semi-urban areas in which they operate. So I think if you accept that these sectors are vital to the economy, and if you also accept that banks are essentially a play in the economy, then I think it's basically the long-term interest of banks to be making sure that enough credit goes into these sectors. Okay,
I buy that argument ideologically, but let me come to the bank, Mr. BAKSHI. Agriculture once was 50% of the economy. Now, in terms of GDP contribution, it's come down to actually 14%. If it's only when you count agriculture and allied activities, you get even up to about 18% or so. Right. So, do you think that in the very least, this 40% should get pared down to something like 14-15%, and that is imposed a little more drastically, rather than this 40% which everyone flouts?
No, 14% agricultural contribution, but we are talking of 40% for total priority sector, which includes industry, which includes housing, which includes other priorities like the soft skills education and other areas. So whether 40% is the right number, I'll not like so, but this doesn't cover only agriculture. Whether there should be directed lending, perhaps we have, despite the maturity of the financial markets, credit allocation perhaps can be left to them, but perhaps we have not reached that maturity, and there may always be a fear that whether these sectors which are considered to be difficult to handle or maybe in remote areas, they may not get their due share. Having said that, the percentages, another thing, they should have perhaps some correlation to the amount-wise contribution to the economy and what is the productive needs. productive needs must be met and they must be ensured to be met.
I don't get you. What exactly do you think the rules should say?
So, for example, whether direct agriculture in the way it is now being defined should be 13.5%, whether there is an absorption capacity to that extent. I am not saying, I have not done any calculation, but the percentages continue to be much lower in that. So is it a manifestation that banks are not lending, or is it a manifestation that absorption capacity as of now is not that much there? So if the credit in the industry grows, or the banking industry grows by 1 lakh crore, 13,500 crore should go to direct agriculture. If it grows by 2 lakh crore, it should grow by 27,000. Whether that type of direct correlation is something, or whether we can find another mechanism as to what is the productive needs of agriculture.
Do you have any quarrel with the original Nair committee recommendation that 9% should directly go to small and marginal farmers from banks and 7% to micro farmers, to micro industries, and the rest, you can even lend to warehousing or cold chain, but at least that 16% is ensured that banks leg it out and find that small and marginal farmer, find that micro small scale industry which needs your money?
See, even now, I'm talking of micro and small industries. At the moment also, 60% of your lending to the MSE sector should go to micro. 40% to those who have investment in plant and machinery up to 5 lakh, and 20% to those who have plant and machinery investment up to 25 lakh or so. So it is already being ensured that 60% of the lending of the MSE sector should go to micro. So assuming that out of 40%, 18% is agriculture, which is not being fully met perhaps, and say about 20% is SSI. So 60% of that becomes 12%. If it is not 20%, suppose it is only 15%, 60% of that is 9%. If it is 10%, then 60% of that is 6%. So perhaps that need was being addressed. So there is no quarrel with that 7%. Direct agriculture to small and marginal farmers alone, whether that could have taken 9% is a question to be, I don't have the statistical base with me, but I feel it looks to be a little high. If 13.5% is to go to direct agriculture, out of that 9% to go to only small and marginal farmers and 4.5 to other farmers, perhaps that may not balance the arithmetic.
Okay. Well, Mr. Parekh, is there a lot of micromanagement over here? Is there a cleaner way to do this?
Well, you see, there are two aspects to it. Let me just, first is I take, Professor Ram's very important input. Banks, by and large, behaviorally, will not really sort of, build their portfolios in keeping with what is priority for the economy. So, normally, because they will, at the end of it, they are responsible to their shareholders in some form or to some various other segments as well. We're talking of system. We're not talking just public sector or private sector. We're talking of the system. I have studied almost about, 11 jurisdictions before I came down over here to look at what is the scenario in other emerging markets. In most emerging, 8 out of 11, you have some form of mandated or directed lending or the other. So, to that extent, the point must be well accepted that there is a need. So, that's one. I think if you look at the limits and if you try and break up the limits, I suppose what MB Nair committee has done is something remarkable. For the first time, it has challenged, or it has at least, spelled out a need to examine the percentages and the breakup between the priority sector for the first time. The idea is, nothing is sacrosanct. Nothing is particularly sacrosanct about either 13.5% or 9%. What is important now, is there are two aspects that I would like to. One is, it is important that between the banking system and the regulator and the government, because government is equally involved.
Yes.
It's equally involved to make sure that it's directed in sectors of economy which are. Between the three of them, there has to be a good database. There are two aspects. Mr. BAKSHI touched upon it very well. One is the absorption. On one side, is the sector capable? Is it bankable? Is it capable? Because you still have to meet with other norms, including security lending, secure lending. So those are the various factors which also have to be considered, when you come down to talking about this. So committee, I mean, I must say, should be commended at least for it is raising this, that all these percentages that we're talking about. I mean, we talked about export sector.
What is the point in directing where the absorptive capacity is questioned?
Is there? There's one more aspect, and
yes.
Sorry, I thought I'd just quickly mention, and that's a structural issue. There's a huge structural issue in the Indian banking. What seems to be happening is all the sectors, starting from cooperative, RRBs, public sector banks, they seem to be focusing on those sectors of the economy where they are easily bankable. Now that is a major issue. Somewhere along, I think we will have to examine why at all did we create cooperative banking? Why did we create? I mean, the preamble to RRBs, for example, must be re-examined. So there is a structural issue as well.
Point is taken, sir. Actually, there hasn't been a growth from bottom up, and that perhaps in combination with the way in which banking tends to be still top heavy needs to be questioned. Well, the other issue in which the priority sector rules have really hurt or hurt some interests in the banking space is that the new rules require foreign banks with over 20 branches to have the same lending responsibility, priority sector lending responsibility as domestic banks. That issue with our guests after the break.